Hey guys, welcome to Investors Relate course number 4. And in this course, we'll be talking about calls, puts, in the money, and out of the money. So let's start with a stock or security. Let's look at Hertz since I have it here. You can actually click it if it's on your recently reviewed, or if not, you just type in HTZ, or you can type in Hertz. HERTZ, and click on it. All right, so we have Hertz here. Actually, we're going to go down to the bottom. I didn't have to click on it. I didn't have to search for it in the watch list. Let's go to the bottom where it says trade next to accounts. So we hit trade at the bottom. And then this is where we'll search it here again. Like I said, if it's in recently reviewed, you can click on it there. Make sure you change the tab from stocks to options if it's on stock. So just click there, options. And then let's search it here just to show you how to show up again. All right. And then we'll click it here. All right. So when you get to the option chain screen, you'll click view option chain. And then once you click view option chain, to the left, if you look at the top under select strategy, to the left you see calls, and then to the right you'll see puts, and in the middle you'll see strikes. And the strikes is basically the strike price that we're saying, okay, this call or this put will hit this price by whatever date we select. So if your strike is on 10, you'll take it to 24, or you can take it to all so you can see all of the strikes. And that's just give you a larger range to see different strike prices. So basically a call, like we mentioned in another class, is a call is saying, okay, I'm betting on this stock to go up. I want this stock to go up. A put is simply the opposite. I want this stock to go down. So on the call side, you have bid and ask price. And on the put side, you have bid and ask price as well. We're going to be talking about bid and ask price, I think, in the next class. And just basically break down what bid and ask is. But if you can see the gray, so if you see the strike prices, you can see at the top, it says $1, then it says $1.50, then it says $2, it says $2.50. So those strike prices, as far as the call is concerned, are in the money. That's why they are in gray. And in the money simply means that the prices are already above these calls. So these are considered in the money. On the put side, you can see starting at $3, $3.50, $4, $4.50, and on up. Those calls are in the gray, and those calls are in the money. And the reason they're in the money is because with puts, you're betting on the stock to go down. So they're already below those prices. So that means they're already in the money. All right. So basically, yeah. So those are in the money as well. So let's just click on a call. So let's look at the 250 strike, which is the 2.50 in the middle. And then over to the left, you have the 65 cent and the 75 cent. 65 cent for the bid price, 70 cent for the ask price. So you're going to click on the ask, and the reason we're clicking on the ask is so we can buy to open. So if you want to say, okay, say for instance, you say, all right, Hertz, I know they just went bankrupt, which is what they just went bankrupt. Well, they just filed for Chapter 11, I think. And you're saying, okay, I know they just filed for Chapter 11, but Hertz, I think they can come back. I think they're still a pretty good company. So I'm thinking, yeah, I think they can hit 250. Well, I think they can stay above and keep going up over 250. So you'll say, okay, I want to try this call, and it expires on June 12th. So as long as they keep moving up, then I'll just continue to make money as they go up. So I'll click on this 75 cent call. And so 75 cent is actually $75 is times 100. So I'll make sure my action is buy to open, because with beginners, we want to do buy to open. We don't want to do any sell to open positions. We want to do buy to open and sell to close to start. So for contracts, I'm going to make sure that's 1, because I only want one contract. and you see the price is 75. So if you look at the bid and the ask, you have 65 there and 75 there, right above add equity. So basically you can fill this call for the median price, and that just simply means the price in the middle between the two prices. So that's 10. That's a difference of 10. So we just divide 10 by 2. That's 5. So we'll just add 5 to 65 to get the median price. And the median price is 70. So instead of paying $75, $5 extra for this call, we're going to take this down to 70. Now you can either type the number or you can hit the arrow here and go down like that. Hit the arrows and go down and up. Sometimes it's faster to type because it's so far away. Sometimes it's faster to just hit the arrow. It just all depends. So you see our estimated total is $70. So we're going to review, and then we're going to place order. Oops. All right. So if you get a call, if you put an order in for a call and you don't know how to calculate the median, just type in a real low price. You can just type in the bid price and it won't fill most of the times. So you can just come to orders and it'll show you the mark price is the median price, which is the mark price. So we did get the price right of 70. The only reason why this didn't fill is because the market is closed. So if the market was open, this would fill. But if you don't know how to calculate the median price, then you can always type in the bid price. If it does fill at the bid, you got it for a great steal. If it doesn't fill, you just go back to orders and you can see the mark price. So you can actually go back here and then you can go to accounts at the bottom. And if you go to accounts at the bottom, you can go to orders. All right. And if you go to orders, you will see your order that's pending. If there's in this base, this order simply means, okay, I submitted the order, but it didn't go through. So it'll sit here. Now, if it did go through, let me cancel this so you can look like, see. So if it did go through, you won't see it here. You'll just see refresh here. And that's a way, if you put an order in and then you go to your dashboard, it usually supposed to show here under positions on your dashboard. If you go to your dashboard and you don't see it yet, you can always go to accounts and go to orders. And if it's not here, that means it's good. It's been filled. So you don't have to worry about it. But if it's still here, then it hasn't been filled. It's just been submitted. And that's basically how we would order a call. Place a call, open a call. And let's just look on the put side. Like I said, puts are exactly the same as calls. It's just you're going the opposite way. So calls, you want the stock to go up. When you have a put, you want the stock to go down. So let's just say, okay, for instance, okay, look at the 250 strike again in the middle, the 250. If you don't, you should see 250 strike. So just say, for instance, you say, okay, you got this point of view. You say, okay, Hertz just filed Chapter 11 bankruptcy. So I think they're going to go down this week. And then you'll say, okay, I want to get the 250 put for $75, which is the ask price. And the bid is $70. So I say, I want to get the 250 put. Now, let me just show you an example. We're going to click the X price here. So click on the X price, and that says buy to open. So next to buy to open action, we're going to click the X because I want to go back out. So let's exit out of here. And let's go to view option chain again. So click on view option chain. And then I want to click the bid price. So let's look at that 250 strike in the middle again. And to the right of that on the put side, you see under puts it says bid. And on the side of bid, it's the 70 cents, not the 75 cents. So let's click on the 70 cents next to the 250, to the right of the 250. And you see when I click on the bid price, you see that says sell to open. So although that's on the put side, if you sell something to open it, you really want it to go the opposite way before you just start making money. So basically, if you put a put in, which normally means, if the stock goes down, I make money. If you sell it to open if the stock goes up, you make money. So we're not, we're at a beginning level here. So we don't want to do that. We don't want to confuse you with that. So like I say, if you make a mistake and click the bid side, always when you get in here before you close your order, look at your action and make sure your action, if you're trying to open a call, make sure it's buy to open. If you're trying to close a call, make sure it's sell to close. So you just want to make sure you're, paying attention to that. And depending on what kind of options you've been approved to trade, it'll give you a warning and it won't even let you sell to open. Because when you sell to open, you have to have a certain amount of cash in the account. And as the stock goes up, you'll make money to sell to open on a put. But if it goes down and keep going down, then you'll lose money, but you don't have any positions. So it'll just start taking away money from your account. So you have to have a certain amount of money in there, because I think your loss is probably like unlimited, whatever amount of cash you have available. But so that's a little bit about calls and puts. Let's see if there's anything else that I can cover dealing with calls and puts. So if you see under HTZ at the top, see where it says select strategy, and next to it, it says calls and puts. Now there are other strategies you can do. You can do spreads. You can do coverage stocks. And a protective put is more like, I think if you have shares, you can do a protective put. Straddles, I do straddles and strangles. And straddles and strangles are basically you're playing a call and a put. So let me just click a straddle here. And it's going to show up differently. I'm clicking straddle and I'm going to click done. And look how my chart looks. So basically, let's go back to the 250. So you see where it says 250 here. So that means you're getting a 250 call and a 250 put. And the way this works is actually a little safe if the stock is going to move tremendously in one direction. And if you look at the volume on this is crazy because Hertz has been real volatile. So the volume on this is crazy because I think the other day Hertz went up 92%. Then like a couple days before that, it had dropped like 80-something%. So whoever had one of these, as long as it goes hard one way, you can you can make a lot of money. And then if you make enough money, say if you put up $75 and you turn that $75 into $225, so that's a 200% profit. So just say once you put up 75 and it goes up, just say for instance it goes up, so your put only costs 75. So once you made 100%, you pay for your put, and the rest, the other 100%, would be profit. So that's why. And then sometimes you can sell, take that profit, and then wait on the stock to go back down to the other direction and make money on both ends, depending on how you play it. But a lot of people do straddles, strangles, and they can be safe and they can be profitable as well. So those are other strategies that you can do with calls and puts. Oh, yeah. So one more thing. I'm sorry. I told you guys what in the money was, but I didn't show you what out of the money was. So out of the money is the white you see here. If you can see the white. So right now at $3 on the call side, $3 and up, $3.50, $4, all of that. To the left, all of that is in the white, and all of that is out of the money. And on the put side, you see $2.50, $2, $1.50, all of that on the right side going up. That is out of the money. Yeah, I told you what in the money was, but I forgot to tell you what out of the money was. But yeah, so that's about it. And you'll be able to see it. The numbers may be different if you're looking on your phone because different days prices change. But you can see what I'm saying from this video. And you can compare it to, whatever stock you're looking at. So see you guys on the next class. Thanks.